In May this year, Neutonic raised $6 million at $60 million valuation. 10 months before that, it was worth 20. 18 months before that, it just started. This video is going to be me talking about how I think all of those raises went down. Now, I wasn't part of any of those discussions. I'm an ex-private equity guy, a fundraiser for businesses as a fractional CFO, but I structure deals for a living. And what that job teaches you is what certain things that happen in a business life cycle mean in terms of the funding component of it. So this video is my honest take on how I suspect the fundraisers went, what the key risk criteria were at each evolution of the company. And I want to be super clear, where I'm inferring, I'm going to tell you that I'm inferring. None of this is official. This is just me seeing a business that I love the product, I'm a big fan of the founders, and I find it fascinating. So my read on Neutonic is they ran 3 critical experiments in the 30 months or so they've existed. So let's go through this examination. So part 1 of this is the raise that happened at the start of the business. Now, the business was self-funded by Chris and James, I believe. The formation of the team and the formation of the cap table is different to the sort of publicly facing story. So the publicly facing story that I've discerned is you have 2 creative founders and they bootstrapped it with their own capital. And actually, when you dig a little bit deeper into the team, you've got obviously Chris and James, but then you have Luke Betts, who, shout out Luke, who I believe is their manager. And I suspect, given that he and Chris are both ex-nightclub promoter boys, shout out all the ex-nightclub promoter boys who have gone on to do massive things. Are very good friends of mine who've done that. They probably knew each other from back then, and I suspect Chris has brought Luke in to be a manager of some sorts, or he's at least included in that operation. And then you have Sean. Now, Sean is somebody that has basically taken over the creator economy. He's done tens of millions of cumulative revenue in his GenFlow business. And I suspect he was saying to himself, why on earth am I creating all of this value for my clients in the agency? And then he's decided to try and get involved with a product that he can push himself and benefit from the equity valuation. I've seen that story 100 times. Anyone that runs an agency will have that. Anyone that's done e-com advertising will think like, why don't I start a brand? I met many of these guys in Marbella recently. So the business didn't take in any external funding, but those 4 founders will have basically priced the various things that they bring to the table in terms of the ops that they give. So instead of doing a fundraise, let's say it was just Chris's idea or just James's idea, they would have had to have gone and fundraised to be able to afford to pay for the other parts that those other founders take on. So with the 4 of them, they cover distribution with the 2 creators. Luke, I suspect, is there on the operational and admin side and just getting shit done side. And then Sean is basically managing the marketing distribution across everything, right? So whilst they didn't technically do a fundraise, in my opinion, 4 of them would have had to have sat down and probably worked out how this all works in order to keep it going. Sean has basically said running creator commerce is what showed him where the scale of the opportunity was. And agencies are notoriously difficult to scale up. But what they've done is they've accurately identified 4 critical parts of running a business in a super competitive space, which is D2C beverages. So to summarize, 2 of them bought distribution, audience in the millions, which would cost their competitors millions of dollars to be able to acquire and retain. 1 has brought the commercial relationships, and then 1 has bought the operational company to help drive the distribution and amplify it. Because the thing that a pre-seed buys, which is your ability to create products, to hire people, to reach customers, and to kind of test the product, that was able to be done by these 4 by themselves, self-funding. Most bootstrap founders bootstrap because they have to bootstrap, but this is why this is so amazing, and it shows the compounding effect of really good decisions taken early on, is that the team structured this so that bootstrapping was the best option by getting the right team in place. Now we're getting into part 2, which is the product experiment. So the business was, I think, running for about 18 months with 0 external money, and the operating hypothesis, and this is a great framework for anyone here, you should always be thinking, what is my operating hypothesis in relation to the risk that I'm taking? So if you're a founder who's got a big bottleneck in your business, write out loads of operating hypotheses around that bottleneck, and it will give you various angles to test it. And the hypothesis on trial here was, is there a market demand out there for a premium nootropic energy product for people with the identity of, I want to work hard and I want to lock the in? That's a very interesting hypothesis just by itself, but I suspect there was something deeper in this. to be able to fund a business to the tune of, I think they funded it to the tune of hundreds of thousands, Chris and James at the start, they must have had something that gave them a lot of confidence to do that. And again, this is just me speculating. This is just me taking interest in this product. And I suspect what happened was Chris Williamson runs arguably one of the most successful podcasts in the world after Joe Rogan. His podcast runs on sponsorships. Sponsorships run on discount codes, which means for years, Chris would have had an insight into what products sell the best using his particular discount codes. And that's something that no market report can really tell you. You can get kind of high level numbers, but you're not really seeing the true velocity of the people that are your core ICP. If you have that data, that gives you a massive amount of confidence in that you'll be able to deliver a product particularly catered to that ICP. And in this case, again, it's the reason I used that phrase before, it's of people who identify as a type, like myself, who want to lock the hell in and get some work done. Red Bull is cool, Monster's tasty, but it's just not the same. Particularly when you add a nootropic blend into the mix. Chris has had deals with supplement brands like Momentous, and in that whole ecosystem of nootropics. I'm sure he's tried them all himself. I mean, I certainly have. I remember spending loads and loads of money on Alpha Brain back in the day when I didn't have a pot to piss in, just because I love the idea of nootropics so much and trying to squeeze that extra bit out myself. And I guess at some stage the question writes itself of like, well, why am I sending this demand to other people's businesses where they get to benefit from my distribution? And this is again evidence that the most important thing now, particularly in software and tech, we're seeing with Lovable and being able to prototype your own tech businesses. But the most important thing now is distribution. So if I'm right about this hypothesis, and again, I stress this is an external outside hypothesis on this, that's the cheapest due diligence and test in the world. You've got all of this evidence beforehand. I know that the business that I was involved in, we had all of this data. And when you're trying to get trust from investors, or even trust with yourself to pursue this particular business endeavor, there's nothing better or stronger than active market knowledge of where people have parted with money and there was a risk taken and people have showed they're willing to buy at a particular price point. And so they launched, and ultimately they were testing the hypothesis of could they get people to buy from some of the most gritty and granular and difficult acquisition channels, which for D2C beverages is online. Now, again, I say this is somebody that would buy from MyProtein in 2021, and they came out with a gamer nootropic energy drink. If any of the guys in Neutonic are watching this, go back and research that. Reach out to me and I'll find it. And I bought stacks of the stuff because I happened to be buying from MyProtein. But I would have never gone out of my way just to buy that stuff. It just so happened that I was doing a protein shake order anyway. Now, consumable products online, they are a graveyard for investors, for founders, all of it. Everyone will know brands that have basically died in that ecosystem because it's very difficult to get repeat buyers. And lots of times those businesses were just meta ads, arbitrage businesses anyway. And they're hard to brand, they're hard to defend, and they're increasingly difficult to get people reordering food and drink the full price that's required, not the discount one that you get at the start. So by July 2025, the guys have done over 10 million in sales globally. And you don't get there in the most competitive category possible. Hello, Snuggles. Yes. Sorry, my cat's coming. You don't get there if you are paying market rent for your customers. Right, now into part 3. And before I give you my verdict on this, you need to see what the standard version of a D2C beverage type fundraise looks like. And what it is it's multiple claims that stack on top of each other. And anyone that remembers their probability in maths from GCSE or whatever is if you have 50% probability and 50% probability, you times 2 together, it becomes 25%. So when you stack all of these assumptions on top of each other, it becomes increasingly difficult to be able to make that happen. So typically that's big category, like protein drinks 10 years ago, growing at massive percentage year on year. Now you have a differentiated product with a very strong margin, and then you have a customer acquisition cost which has a favorable lifetime value to CAC ratio, and you have some scalable acquisition channel, which is basically meta ads, and then you basically have a slide of logos at the end of your pitch saying these are the people that we think will acquire us once we've hit a certain level of EBITDA. And that's kind of the genre of pitching that I've seen for these types of brands. Now, again, in most raises, this is like fictions and assumptions that you've made, and there's no real evidence for it. And the person investing is basically taking trust in the person that's delivering the message. They might believe that you can hit all of these numbers, but ultimately it's about trust that the person will execute and will not stop until they've executed on those particular metrics. But the reason why most of these brands fail, notoriously, is because they are not proper brand businesses, they are meta arbitrage businesses. And the brand is basically a margin on the paid traffic that you can drive to that site. Now, if you take that template and you compare that to what Neutonic had achieved by the time they got to this point in the company's growth cycle, it becomes very, very apparent that this is not a typical business in that regard. So the distribution channels are like a core critical part of the business. It will never fade away as long as Chris and James are doing their content thing, and because they are utter missionaries in this space, I don't think that will ever change. That's something that investors can trust. They can put the house on that, which means your CAC for your core part of your cohorts is going to be so much lower than anywhere else. And we'll get to the exit, but a normal DC raise basically asks investors to believe 6 different things. At the Neutonic raise, they probably only need to ask, do you believe that we can keep doing content and keep having this buy-in for this ICP? Given the success of the two main front-facing founders, it's such an obvious non-risk question. Now, the first external round was July 2025. So that was done at a 20 million valuation with 10 million of sales already done. So let's do the maths together. So 20 million on 10 million of trailing sales is roughly 2x revenue. Now, that's pretty conservative, but it seems to me like that round was done to maximize valuation, because I think the guys realized that actually whatever happens from this point on, this will be a success. Even if we just transition it into a business that becomes a cash flow generator, we're not in any position requiring to exit this business within a timeline to make VCs happy, which gives them so much strong optionality. And so they basically built the list of the people that they thought would say yes and understand this, which is a fantastic way of doing it. I have multiple clients that I'm fundraising with at the moment, and this is a big part of the job, is saying like, right, if we have like a car parts premium brand that we're raising for, I've made that up completely. But what we want to do is we want to find people that understand car parts, have made their money in car parts, understand what the pain point is for the ICP that is being sold to, and then will believe the team to be able to go out and achieve it because they know what success looks like in that industry, because they were a successful person in that industry, right? Now, let's look at who said yes to this fundraise. So you had Alan Barrett, a guy that built Grenade, and subsequently on the back of UK grocery and retail domination, sold to Mondelez in 2021 for, I think it was 200 million quid. So like one of the most successful retail brand founders in the UK in recent memory. And then they also got Cody Sanchez, they got Dan Martell, Jay Parker, who built Gym King. And basically this is like an Avengers Assemble of people that have their foot in the content creation space, but also the retail space. So that's scarring and lessons learned from retail. That's creator reach. That's category exits. And really, I think the capital in this case wasn't the most important thing. I think that they could have gone to a firm that was like a city firm and said, look, we are the team. We want you guys to invest at 5x valuation. But that would have changed the way to the exit, which is what we're getting to now. So the guys had the proof that the business was working at this point in time, and now it's a case of learning and taking the big guns. Now, what's going to take Neutonic to the stratosphere, which is what we're seeing over the past like 3 months, is their inclusion. And this is the best like recent example I've seen of like decisive business action in the consumer marketplace. And this is putting Neutonic as part of the meal deals in Sainsbury's. Whatever money they might be losing on that deal to fund the discount is just going to completely change the game for them. Because, let me tell you why. Neutonic is a premium product. A can of Neutonic costs £3, I think, if you're just buying it off the shelf. That is a relatively high risk purchase for somebody that isn't familiar with Chris, isn't familiar with James, isn't really that interested in nootropics. Now, I always speak to customers whenever I'm interested in something. And it just so happened, I was going to Sainsbury's probably 2 months ago when the meal deal just started. And a builder chap, like a scaffolder bloke, come out and he was carrying a Neutonic can. And I said to him, oh mate, what do you think of that Neutonic? He said, oh mate, gets you buzzed. And I thought, oh hello, that's very interesting. They have somebody on the cap table that had exactly that problem back in 2012, 2015, Alan Barrett with Grenade. Because Grenade was the first proper tasty protein bar that we had in the UK. Because I remember at the time, you couldn't get Quest bars in the UK. You had to order them online, and it was some really difficult. And Quest bars were amazing. But then you went and tried a Grenade bar, and they were just as good. Now, again, I was a teenager at the time, but I remember thinking, wow, if I can get a Grenade bar, I'm going to buy it. But They're also really expensive. Now, I was the core ICP again. I was like one of the first people to buy a Gymshark singlet, which I have upstairs even. So I was open to buying grenade bars. But now everyone buys grenade bars. And why is that? Well, it's because Alan managed to get them into Sainsbury's, into Tesco as part of the meal deals because it's a low risk purchase. Put yourself in the position of, John Smith, the office worker. He's popped down to Sainsbury's to get his meal deal for the day. He gets his classic BLT. He gets his, in this case for grenade, he's usually goes for a bag of McCoys or Walkers. But actually, he sees this little chocolate bar and thinks, you know what? I'm lifting weights, I'm running, I'm exercising, protein's good for you. Oh, look, they're branded with Oreo. Let me try that. So instead of paying the £2 that he would have paid for a bar to start with, he's taking a low-risk choice as a consumer, but the price of his meal deal doesn't change if he goes for the McCoys or the grenade bar. So I suspect Alan saw massive success with this and told the guys, like, look, we need to take part of this money that's coming in this fundraise to subsidise the distribution through the meal deals. So that's risk one, is a premium. And at that point, because the product's good, you've got mass distribution, you can rely that there's going to be retention. And again, that brings your CAC down. And it also means that the velocity of cans going into Sainsbury's across the country is going to ramp up. The negotiation terms change. There will have been a Excel or spreadsheet done, which basically says at some point, if we hit X amount of velocity through these Sainsbury's stores, we will be able to renegotiate with Sainsbury's. So they'll give us a discount on the various fees and all the stuff that kills brands, and we will become profitable on a massive level just by the sheer scale of this. I talk about scale there because that's risk two. Risk two, that loads of people don't realise, is as you scale up retail brands, you end up crashing them. Now, why do you end up crashing them? Well, anyone that's worked in business or finance or investing knows about something called working capital. Think about it like this. If you make £1 million worth of revenue, but it costs you £500,000 to get the inventory for the next month, well, then you've got to take £500,000 from that million revenue and put it into the working capital, which the textbook definition is your current liabilities and your current assets netted off against each other. And that's the amount of cash you have to keep in the business to basically keep it functioning and creating revenue. Cans are heavy, they're cheap on a per unit basis, and they are an absolute nightmare to ship. So that's why pure DC beverage businesses barely exist for that reason. The unit economics are not favourable. But retail brings its own trap in that going to thousands of stores means loads of stock sitting in warehouses, means trade spend, grocery payment terms, 60, 90-day terms, whatever it may be. And in that model, growth eats cash, even whilst the P&L might look amazing. And the more you sell, you're poorer for months at a time. So this aggressive growth curve, this is kind of make or break for the guys, and I suspect that's why they just recently did this monster fundraise, because they saw the success of the first fundraise and they were like, wow, we've got a winner here. Now, unfortunately, we need to fundraise against this success in order to fund the rollout across these stores. So pay for the Sainsbury premium that they'll probably have to front on the price difference to get in the meal deal, and then pay for warehouses of stock and supply to be made. So what the guys have done with the meal deal is effectively turn every single Sainsbury's in the land into a Neutonic sampling checkout. Now, it's very important to note that brands typically have to fund part of that meal deal discount through the trade terms. So the trial isn't free to Neutonic. It's basically going to be earmarked as customer acquisition spend. Now, the final part is the exit. And this is where it gets very fun and interesting. Now, in a normal DC raise, again, like I said, it's a wall of logos, and PepsiCo paid for Poppy, and, well, Keurig Dr. Pepper bought Ghost for a crazy valuation. Now, this product is unique in the regard that there isn't really a brand like this at the moment. And I think that by the time it gets there, it's not going to cannibalize the market, which is basically Chris and Joe Rogan watchers, who are the core market of this. And they're not going to be able to come and take it. And ultimately, Onnit survived, being the core provider of nootropics. They didn't have any moat really apart from their branding, but that still became a business worth hundreds of millions. And it also means that why would you go to the risk if you're PepsiCo, you're a massive publicly funded business, you've got lines of credit with all the banks against your shares, why would you bother trying to hire people to compete with Chris and James and Sean and Luke, and obviously the backing from Alan? Why don't you just raise some money on the public markets on a bond yield, and pay for a yield that's an arbitrage? You cream the valuation there. So for example, if they're going to pay 200 million for this, or let's make it round numbers. So let's say a 5x at this most recent round. Let's do for 300 million, right? So they sell for 300 million. So Pepsi as a business, here we go. So imagine you're PepsiCo, right? You've got a market cap of approximately 187 billion USD, right? So that's the total amount of shares outstanding times by the share price, right? And that will fluctuate with the share price. Now, they've got a strong investment grade credit portfolio. Basically what that means is at any one point in time, they've borrowed money from public markets on liquid assets that are tradable. And they're rated as A1, A plus by S&Ps and Moody's, which basically means that the price of them borrowing money, i.e. the yield they have to pay investors to be able to borrow money from them, is low because there's trust and there's a low risk that Pepsi as a business is going to go under and not be able to fulfill its liabilities to investors. Now here, they've currently got 52 billion outstanding and their debt levels have increased, but they're manageable given their free cash flow. So currently the shorter term bond yields are in the 4 to 4.5% range and longer term yields are at 5.3 to 5.7. Now, people are very familiar with this idea of valuation as a multiple of EBITDA or revenue. However, what people don't think about is how yields are included as an inverse of a multiple. So a 20x multiple, if you divide 100 by 20, that is a 5% yield effectively, is what you're saying. So if Neutonic were bought at a 10x, that would be an inverse yield of 10%. What that means is Pepsi could just do a bond raise. That gap between what Pepsi can get funding for and what they've paid for an asset that's delivering a certain percentage yield, that's additional value creation. So this is one of the things that you've learned in mergers and acquisitions. This is where you try and find those spreads and you can crystallize that. Now, why do Pepsi do this? Pepsi do this because they cream the difference in the valuation, but they know there's a massive market now. The really simple question is, would Pepsi be able to build and create this business with $300 million worth of their free cash flow faster and have a better longer term viability than Neutonic if they acquired it for 300 million? That's why I'm so confident on this business being a wild success, because there's no way, not even Coke could do this. And that's why they acquire them. You look at Poppy, you look at Celsius, you look at all these brands that have been acquired, you look at Ghost. They've all been acquired because it costs way more to build it. So in terms of the exit, I think the exit component of this is the strongest case. I'm sure the guys would have said to everyone they were fundraising from, like, look, we're going to build this business with the intention to not have to sell it within a time window. I hope you are earmarking at least a 10-year hold on your capital, because that's how you get the best valuations from these guys. You get the valuations by not wanting to sell and by bidding up an auction. I suspect there'll be a time in the next couple of years where Coke, Pepsi, Keurig, Dr. Pepper will all be bidding for this in an attempt to get a foothold into the nootropic energy drink market. So let's run the tape back. So we've had 3 experiments. You've had about 30 months. And again, this is my read from the outside. And raise 0, you got the founder capital. You're testing whether the demand was real based on the stuff that Chris has seen in his podcast, I'm guessing. And it's been graded by the amount of repeat purchases you get D2C. Check. The next round, deliberately cheap fundraising, testing whether or not the brand transfers to strangers, graded by the shelf velocity and the select picking of the investors. Check. And now we're going to find out about the Sainsbury's numbers. If you found this useful, like, comment, subscribe, send this to your friends that are founders. They'll learn something from it. Leave a comment if you try Neutonic, if you think that this investment thesis is a good one, and we'll stay in touch.